Hello and welcome to Module 2 Part 3. My name is Elizabeth Gagan and I am the Head of Fixed Income Strategy at Goodbody. In this video, I'll be teaching you about something I work with every day, bonds. It's probably the most complex topic we've covered so far in our course, so let's start with the basic definitions. What is a bond? Essentially, a bond is a loan made by an investor to a government or company that needs to raise money. Similar to a loan, the bond will have an agreed timeline or borrowing period, and at the end of that period is called the maturity date. People who invest in bonds are called bondholders. There are many ways to invest in bonds, but the simplest example is whereby a bondholder invests in a bond, keeps the investment until the maturity date, and receives the principal or loan amount at the end of that period. Throughout the life of the bondholder will also receive a regular interest payment, known as the coupon amount. Interestingly, it is because of this regular fixed interest payment that the asset class was named the fixed income asset class. As with all asset classes, there are always some key terms to understand when looking into them. One of the first ones to consider is the coupon interest rate. As with any loan, there are costs of borrowing, and for bonds, this is reflected in the coupon interest rate. It is the rate charged by bondholders to compensate them for the risk of lending to the corporate or government. It is an interest rate which is determined based on the risk of the borrower and the current market backdrop. It's quoted on an annual basis and can be paid annually or semi-annually. Coupon interest rates, or coupon rates for short, may sometimes be confused with bond yields. However, they are not always the same. Whereas the bond coupon rate relates to the annual interest received each year, the bond yield refers to the total potential return which an investor can achieve if the bond is held to maturity. It is quoted on an annualized basis, and it is different from the coupon rate as it considers both the fixed coupon payments but also the bond's current market price. I'll explain how the current market price can impact the yield later on. But before then, it is probably important to understand why one would invest in bonds. The first reason comes from one of the golden rules of investing that Orla told you about in Module 1, diversification. As we know, diversification relates to the spreading of risk. It is the quintessential don't put all your eggs in one basket. One way to achieve this is to ensure that the sources of returns in your financial portfolio are not all driven by the same thing. In this way, the journey of your investment returns is a lot smoother and less volatile than if one was invested in a very focused single basket portfolio. Bonds make a great diversifier in a portfolio as they will have a different return profile to stocks. Typically, bonds are considered to have a negative correlation with stocks, meaning that they often act in an opposite direction to stock prices. This is particularly useful in times of market volatility or stress, when stocks are falling, as oftentimes bond prices will rise. How much bond prices may rise depends on a few factors, but typically the best quality bonds, such as developed country government bonds, will provide balance to a portfolio in these periods. In this way, adding bonds to your portfolio of stocks can help smooth the journey of returns. Bonds also offer a degree of certainty around your invested capital or money. We referred to bonds earlier as a loan, and as with any loan, the principal must be paid back at the end of the lending period. Hence, bonds can help preserve your wealth because, unlike stocks, where the prices fluctuate continuously, there is a maturity date for bonds at which point a known principal amount must be returned to the bondholder. The only exception to this is if there is a default event, when a company or government does not meet a payment obligation. But investors will look out for this when assessing the risk before investing. In terms of risk, as we know, bonds are debt instruments. In this way, interest rates play a huge role in their valuation. As a result of this, investors will generally try to gauge what they think will happen to interest rates in the future before investing. However, it is also important to assess and identify the different types of bonds available, as there are individual risks associated with these too. For simplicity, we can say that there are two types of bonds: government bonds and corporate bonds. Government bonds are issued by governments, while corporate bonds are issued by companies. All else being equal, corporate bonds are considered riskier when compared to government bonds. This extra risk would then typically mean that corporate bonds will have a higher coupon or yield associated with them to compensate investors for the additional risk. Remember from Module 1, the lower the risk, the lower the return. When the risk is greater, there is a potential for higher return. However, this is quite a broad statement, and we would very quickly find examples where this is not the case. For example, a corporate bond from a high-quality, extremely profitable, and well-established corporate may not be riskier than a bond from a low-growth government. And as such, the corporate bond may have a lower yield or coupon rate. One way to simplify this is to look at the credit rating of the bonds. Credit ratings aim to assess the financial health of the borrower, be it a corporate or a government. Each bond is given a rating which reflects the ability of the issuer to repay the debt in full and on time, and will be granted by an individual credit rating agency such as S&P, Moody's or Fitch. Bonds with a credit rating from AAA to BBB are considered to be high-quality investment grade, whereas those with a credit rating from BB and below are considered to be non-investment grade. Non-investment grade bonds will often be called high-yield bonds, as the yield or coupon on these bonds will typically be higher than the yield or coupon of an equivalent investment grade bond. The reason for this higher yield is to compensate investors for taking extra risk. Speaking of risk, I mentioned before that interest rates play a crucial role in the valuation of bonds, and that investors try to assess the interest rate environment before investing in bonds. This is important because bonds are said to be inversely related to interest rates. What I mean by this is that bond prices will fall as interest rates rise and vice versa. Hence, the movement in interest rates can be a risk for bonds. For example, after the pandemic, central banks across the world hiked interest rates significantly in order to fight inflation. The knock-on impact of this was that bond prices fell dramatically. In this way, trying to assess the future path of interest rates can play a big role in the investment process and will influence which bonds investors choose. Similar to assessing the credit rating of a bond, investors also need a way to assess the risk associated with interest rate moves. This measure is referred to as duration. The duration of a bond measures how much a bond price will rise or fall relative to a move in interest rates. It is loosely connected to the maturity profile of the bond. For example, it is possible for a bond with 10 years to maturity to have a duration of 10 years. Typically, bonds with longer duration, say 10 years or more, will be more sensitive to or react more to interest rate moves relative to short duration bonds, which may have a duration of 3 years or less. There are a few reasons for this relationship. Ultimately, it relates back to why bonds are inversely related to interest rate moves in the first place. But we will outline that at a later time. What's of more importance is to just remember that longer duration bonds will react more or be more sensitive to interest rate moves in either direction. Speaking of these bond price movements brings us back to our initial comments about bond yield and coupon. Sometimes the bond yield is confused with the coupon rate, but there are important differences. The coupon rate is the annual interest earned by the bondholder, and it is fixed at the time that the bond is issued. The bond yield aims to capture the total return achievable if the bond is held until maturity. If nothing happens to the bond price, then the coupon rate and the yield will be very similar. However, as I have just explained, the bond price may fluctuate inversely with interest rate moves, meaning that the price may rise or fall. The bond yield aims to capture the total potential return and will be the sum of coupon payments and any price gains or losses. In this way, bond yields can fluctuate through time, but the coupon rate will remain the same. On that note, it's time to wrap up part 3. Bonds can be complex and difficult to understand when you're new to the world of investing. But I hope after today's module, you understand the mechanics of bonds and that you feel better equipped to get started with fixed income investments. So, before I finish up, let me leave you with a few key points. First and foremost, bonds are debt instruments and can be thought of as a loan by the bondholder or investor to the government or corporate who is issuing the bond. Bonds will pay interest each year determined by a coupon rate on an annual or semi-annual basis. There are two types of bonds, government and corporate, and within this there are also different types of credit rating categories. Finally, bond prices are inversely related to interest rates, meaning that prices will fall as interest rates rise and vice versa. So, in addition to credit risk ratings, there is also the duration risk measurement, which should be considered when investing. Of course, as with any investment, it's important to consider suitability. Before you invest in a bond, you must make sure that the bond timeline and risk profile suits your investment goals and objectives. Remember, you can only invest in bonds through a broker, so talk through all the options and be aware of the risks involved. In Module 3, you'll be learning more about picking stocks, evaluating companies, and interpreting your results. If you have any questions about this module, don't hesitate to contact us.